Ladies and gentlemen, if I could have your attention for just a moment. Thanks, everybody. I'd just like to introduce Patrick Smith from AMC Consultants, one of our key sponsors, who will give a brief introduction to our speaker. Thanks, Patrick.
Ladies and gentlemen, it gives me great pleasure to be able to introduce Chuck Jenez today. Chuck is a mining industry veteran, 30 years of experience. President and CEO, he has helped Goldcorp to grow into one of the world's largest and most successful gold mining companies. They have mining operations and development projects all through the Americas. Prior to his current appointment, he was Executive Vice President, Corporate Development, and in that role, he led many of the mergers and acquisitions transactions that have contributed to the company's growth. Before joining Goldcorp, he held senior positions with Glamis Gold and Placer Dome. He holds a BA degree from the University of Nevada, and he also graduated University of Arizona School of Law with honors in 1983. Practiced law for 12 years and has a broad experience in capital markets, public and private transactions, financing, and international regulation. I understand that when Chuck's not running a company with 19,000 employees worldwide, he's spending time with his cattle ranch in Nevada, enjoys fly fishing, boating, and skiing. So, members and guests, could you please join me in welcoming Chuck to the Melbourne Mining Club?
Thanks very much, Patrick, and thanks to the Melbourne Mining Club for the opportunity to be here. This is something that we've been working on for some time, really in much of the 6 years that I've been CEO of Goldcorp, trying to find a reason to come to Melbourne to talk to you all. And it's been a problem. Part of the problem is, as you know, we don't have any assets in Australia, and so I don't get here too often. And given, as was just described, the fact that Goldcorp has grown very quickly through a lot of mergers and acquisitions, I have to tend to be a little careful about where I show up, for people will wonder what we might be up to. But I can assure you that my only reason for being here today is to speak to you. I want to start today by saying what I'm not going to talk about. I'm not going to stand up here and list everything that we've done wrong in the gold business over the last 10 years. You've heard that very articulately from Nick Holland and others, and I agree with most of what they've said, but I do feel pretty strongly that it's time as an industry for us to stop beating ourselves up, stop deriding our business to our investors and others, and instead it's time to focus on the things that we're doing right as an industry and what we're going to do in the future to be successful businesses and attractive investments to our shareholders. So what I want to talk about today is to present to you some of the things that we're doing at Goldcorp and that I know are being done elsewhere in the business to be successful going forward. And as a result of seeing what's going on elsewhere, and not just at Goldcorp, I'm quite bullish on the gold sector and our prospects going forward. It's not just because I'm bullish on gold price, which I am, and I'll also talk about that, but also because of the changes that we're seeing at the companies themselves. I think we've seen financial discipline. It's a word or a term that's overused, but I think it really is taking hold within the gold sector. We're seeing steady reductions in production costs, smarter allocation of capital through the deferral of projects that make no money. No matter how hard it is to lose a very public bid for another company, we've at least seen at least one company not overpay for an asset. And if you're not sure who I'm talking about, that's Goldcorp just recently. So let me move forward here. I have to put this in for U.S. securities rules. Please read it at your leisure, but I will be making forward-looking statements, and you should recognize that there are risks in such statements. This slide, I think, shows very simply one of the key positive trends that I'm talking about, and that is a steady move towards lower costs in our sector after a long period of costs increasing, and I fully expect this trend to continue. And so, as I said, in my view, I think the gold sector is on its way back to relevance for investors. I think Goldcorp and a few other companies will generate strong returns even at the gold prices that we're seeing today. And the whole sector will be better prepared for success when the gold price goes up. So before I talk about some of those details, I do want to focus on gold price just a bit. And as was mentioned, we had a nice run here just yesterday. But I believe that the price of gold is going to rise significantly over the next 5 to 10 years. I'm not going to stand here and tell you it's going to 5,000 or 10,000. I think it'll be much more moderate than that, but steady. And I'll talk about some of the reasons. First is that I think we're very close to a peak gold scenario. And what I mean by that is I don't think that we will ever produce as many ounces of gold as we do next year. And for the years after 2015, we'll see a steady reduction in mine supply that frankly will not be changed. And I know there's some risk in coming out and saying that. All the folks who were talking about peak oil a few years ago are now hiding under tables somewhere. But I think you can look at some of this data that we're going to talk about, and I really think it is ahead of us. So let me look at this one slide. And this is a remarkable slide to me that shows the millions of ounces represented in the gold bars that have been discovered. And if you can see the years at the bottom, as we have gotten closer and closer to the present day, we've discovered fewer and fewer new deposits of gold. And that, if you can see the gold line, is despite spending dramatically higher amounts on exploration worldwide in our sector. And then another factor that we deal with is that it takes longer and longer to develop new mines. And we're all well aware of this due to government restrictions, Aboriginal disputes, political instability, and stakeholder opposition. Some discoveries out there will just never be built. But you can see that the average time from initial discovery of a gold deposit to production has increased to almost 20 years. And so if you put those two slides together, it's pretty interesting that I don't think it's a coincidence that peak gold production that we expect to see next year is coinciding with that 20-year development time from when the most gold ounces have been discovered in our business. So without the new discoveries to offset normal production declines, I think gold supply will be going down and lower going forward, as you see on the right-hand chart. But that's only half the story. So what's happening on the demand side for gold? There is no question that demand for gold worldwide has dropped in the past 2 years, and that's, of course, the leading factor as to why the gold price is down. But I think it's important to look at the different elements of demand, and you can see some bright spots out there, actually. In simple terms, I look at gold demand as two general buckets. And one bucket, you've got financial demand from the financial investors, or also called investment demand. And then in the other bucket, you've got physical demand in the form of bars, coins, and jewelry. And the levels, as you can see in this slide, for those different demand areas have been quite different. And when you look at investment demand in particular, it dropped strongly in 2013 as investment dollars were drawn elsewhere, primarily to the U.S. equity markets. But at the same time, we've seen dramatically higher physical demand in where else but China. And I'm sure here in Australia you're tired of hearing about how everything is driven by what happens in China, but I'm afraid I think that's going to be the same for gold markets going forward as well. If you look at this slide, in 2013, when 800 tons of demand rushed out of the ETFs, this financial demand, physical demand in China increased by 600 tons at the same time. So we really saw essentially a dramatic movement of gold from New York and London to Hong Kong and Shanghai. And here you can see that throughout that increase, the Hong Kong numbers as contrasted with what you see in the ETF outflows. And then this slide is one that I think is fascinating and very, very topical to what's going on with the gold price today. The blue line is the gold price, and the red bars are the per ounce premiums that are paid in Shanghai to buy an ounce of gold. And so what's happened is that each time, if you can see in these ellipses, each time the gold price has dipped down below $1,200, the premiums shot up, meaning the demand for gold shot up to the point that people were willing to pay $50 more than the spot price to get an ounce of gold. And so the question, and I thought maybe when I was putting this together that we might be seeing this question answered today, in fact, had the gold price not bumped up yesterday with the Fed minutes, we might have tested this $1,200 level again. And my thesis is that when we do, and if we do, you will see the demand increase dramatically again. And these are numbers that we only get after the fact and we have to look at after they've happened. But the bottom line is I believe that this demand is essentially establishing a floor for the gold price going forward. It's interesting that I was just watching CNBC International before I came over here, and there was another fellow on there saying that gold was going to $900 or below. And if you think back to April of 2013, when gold came dropping down from 1,800 to below 1,200, every talking head on TV was saying that it was going down to 9 to 8. I heard a guy the other day say it was going to 660, and they were wrong. They were proven wrong in 2013, and I think this data is going to prove them wrong again. The Chinese, we were just there yesterday and earlier this week. Chinese have a cultural affinity for gold. They're building wealth in millions of individuals who are interested in diversification of that wealth, just like anybody else is. And it really doesn't matter for purposes of this discussion whether China GDP grows 7% or 5% or 4%. The fact is they're making millions of new middle-class investors, and a share of those investments are going to be in gold. So in my view, the supply-demand fundamentals are very strong. We'll need to work through the current uncertainty around the strength of the U.S. dollar and the expectations of rate increases in the U.S. that are keeping the investment demand side very low. But I believe the fundamentals will drive a steady increase in the gold price beyond 2015. So if you disagree with that, the rest of what I have to say is probably not too relevant to you, but I'm going to now talk about what I believe we need to do as an industry in order to take advantage of those increasing price levels and as I said earlier, make ourselves an attractive investment proposition for our shareholders. So this slide, well, I think that slide's out of order, but let me just, you've seen this slide. This is what it's looked like the last 10 years. We've seen a dramatic increase in the gold price, but at the same time, although I've got a little advertisement for Goldcorp in there, the net increase in the overall gold stocks over that 10-year period was zero. So we didn't perform as Nick and others have come and talked to you about in the last cycle. How do we go forward? What do we do differently next time? This slide sets out what I believe are the keys, and these are the things that I'll spend the rest of my time discussing. First, I think we have to focus on those things that make us a successful business. Solid returns on our capital invested, and then smart allocation of the returns that we receive. It sounds simple, but the fact is I don't think gold companies 5 or 10 years ago were really focused on these business fundamentals. They were setting themselves up to be primarily a leverage play for the investor. And if you think back to the creation of the ETFs in 2004, before that, if you wanted exposure to gold, you had to buy a gold stock. As an institutional investor, it just wasn't practical to buy physical gold and deal with all the insurance and storage issues. So investors wanted leverage to gold, and that's what we gave them. We gave them more ounces in the ground, more ounces of production, and we were delivering ounces and growth in ounces without delivering the kinds of financial returns that they were expecting. And so since the advent of the ETF for gold, which they are everywhere now, investors can get leverage without buying gold stocks, so we have to provide more. And I think some companies have been slow to accept this reality, but I'm confident everyone realizes that it's much more than leverage today that we have to provide. We need to provide real returns, as I said, in our invested capital and not just chase ounces. And then those returns will allow us to invest in new high-quality, high-return projects and pay sustainable dividends. And those are things, of course, that the ETF can't do. Again, I think this is already happening. Big projects that, as configured, won't actually make money at these prices are being deferred. Pascua-Lama would probably be the biggest example of that, but there's scores of others that you can think of. Dividends have also been an important part of everyone's capital allocation the last couple of years. Unfortunately, most have had to reduce or suspend their dividends with the lower gold price, and I'm very happy that Goldcorp is, if not one of, I think the only gold company that managed its affairs such that it didn't have to reduce its dividend. In either case, I'm confident that dividends are going to remain an important part of capital allocation across the sector and be an important differentiator for us compared to the ETF. And then the second big change needed going forward is the recognition, again, of one of the key reasons investors buy a gold stock, and that's to have leverage to the gold price. But what is leverage? It's not just more ounces. It's the margin growth that leads to improved financial returns when the gold price increases. And to do this, we need to run our mines in a way to allow for margin growth, and that's going to take a level of discipline that we just didn't see in the last cycle. So I said I wasn't going to focus on our mistakes of the past, but I guess it's sometimes necessary to look back in order to best understand the change that we need going forward. So this is a pretty simple slide. It just shows the increase in the all-in sustaining costs of mining an ounce of gold on average for the industry. At the same time, you see the gold price increase in the yellow line. And the fact is, as I said, gold price rose, but the cost rose just as fast, so there was zero margin growth. And then this slide just takes that same data and compares the actual margin to the gold price, and it's just remarkable when you consider how much the gold price went up during this period that the margins actually went down. So imagine that you're a portfolio manager. You make a macroeconomic call in the early 2000s. Based on everything going on in the world, you think that you should buy gold. And so because you don't have any other choice, you load up on gold stocks, and it turns out that you get that macro call exactly right, but most of your gold stocks do nothing because they have no margin growth. and their costs are going up just as fast as the gold price, so nothing happens. And I think that was the primary disappointment that caused the underperformance of gold stocks over the last several years. So I want to talk about how that happened. And most people would say, well, it's cost inflation. Everybody was building mines at the same time. Everybody was hiring engineers and suppliers at the same time. So the costs trended up, and there's just not much we could do about that. I think there's another factor that we do have control over that has a big element to play here, and that's grade. Before I talk about grade, I do want to digress, if you'll allow me. You see that I'm using all-in sustaining costs as a proxy for cash flow per ounce, and I want to just stand here and say I really believe in all-in sustaining cost as a measure of performance in our industry. It's not perfect, but it's tremendously better than the old measure of simple cash costs. And some in the industry have stated loudly to the opposite effect, and I just think they're wrong. The main reason is that all-in sustaining costs include sustaining capital. And mines spend a lot of money on sustaining capital, whether you're buying periodic replacement of trucks and other equipment, but it also includes regular costs that are incurred day in, day out, every day of the year during a period of operating a mine, and that is stripping, deferred stripping in an open pit, and development work in an underground. And if you talk about operating costs without including those sustaining costs, you're missing a big chunk of the actual cost of mining an ounce of gold. So most of us in the business, through the World Gold Council, wanted to come up with a better way of measuring the actual cost so that we could talk real numbers with governments, with stakeholders, with our own people. And as I said, it's not perfect, but it's a lot better than the old cash cost measure. And of course, we all are public companies. We still provide financial statements prepared according to GAAP and IFRS, so you can see the formal measures of our cash flow and income, and those are always available. So I just want to say I do not understand those who criticize the measure and continue to use cash costs, which in my view is a radically less accurate measure of performance at a mine, and particularly at a time when gold price is down and investors are looking so hard. They need a simple way of seeing the cash performance of the mines. So thanks for letting me digress, and back to grade. The fact is that gold price went up. The industry started chasing marginal ounces by lowering cutoff grades. And this goes back to my point about smarter capital allocation going forward, but it also goes straight to the cost issue and that main reason for lack of margin growth. So this is a pretty remarkable chart. A nearly 80% negative correlation between gold price and grade over the past 10 years. So lower cutoff grades at our mines led to more ounces, but low quality ounces, and therefore much higher per ounce costs. And it wasn't just from building new low-grade mines. This was going on at the mines that we operated along the way. And you can see here that this slide looks at the actual mined ounces versus reserve grade. And you can see how much above reserve grade the industry was actually mining. And this resulted, again, as I said, in maximizing ounces, but at a constantly declining grade, and therefore higher per ounce costs. I said at the beginning that we all get it, and it's small and hard to see, but if you look at the end of what happened in 2013, you're starting to see the trend reverse, and that is mined grade and reserve grade is actually increasing, and I expect to see this improvement continue. Now, this is a busy slide, but this is something that we actually use with our mine managers, and I want to walk you through it because it's not as simple as you would think about how to run a mine when it comes to grade. So I've tried to use simple numbers here. Imagine there's a mine using $1,000 gold price as the number for its mine planning. And then in the right-hand column, the gold price jumps up to $1,200. Well, the general manager has lower grade material that he can chase. They always do, whether it's in another stope underground or a pit laid back in the open pit. So he runs these numbers, and he decides that he can lower the cutoff grade and increase throughput to mine more ounces. And the cost of those ounces goes up, but since the gold price goes up as well, the margin is protected, right? And as you can see, not really. The margin actually goes down a bit from 20 to 17%. So as I said, it's not really that easy. You get top line growth, you even get cash flow growth. And but your margin has gone down. And if you haven't issued new shares to finance this throughput expansion, you may even get cash flow per share growth. And so will an investor be happy with that? Maybe, but remember that it takes some form of capital to fund that expansion, and I bet you didn't make much of a return on that investment because you were funding the chasing of low-grade ounces. But that would be a best-case scenario. Now look at this one. This is more real life. At a mature mine that's getting deeper and more expensive, the reduced cutoff grade and throughput increase simply allows you to continue to produce the same number of ounces. So in this case, costs go up, cash flow doesn't increase, and margins go down. And if you add a capital raise to this, so you get a little dilution of your shares, this is the recipe for value destruction. And again, I think this is certainly a lesson that we've learned at Goldcorp, and I'm confident that others have as well. Now, these are ugly charts showing the multiples ascribed to gold companies on both a net asset value basis and cash flow per share. And they are at the lowest level in my 30 years in this business. But I see this as an opportunity, as I said at the outset. If we can manage our costs, make good investment decisions for the allocation of our capital, and provide margin growth by avoiding the temptation to chase low-grade ounces, I think we can recover some of this valuation and provide strong share price accretion for our investors. I said at the outset, I don't see this as just a hope for the future, but I think the companies are already taking the appropriate steps. I know we are at Goldcorp, and I look forward to the value creation that I expect to see in our sector for the coming years. So before closing, I just want to relate a meeting I had with an investor just a couple of weeks ago in Boston. And he had previously owned Goldcorp, but was currently out of all of his gold stocks. And we went through all this during the meeting. And at the end of the meeting, I asked him what it would take to get him back into the gold sector. And he said, well, he wasn't sure about gold price, and he'd kind of wait and see what the Fed did and then decide when he saw a run coming would be the time to get back into gold. And I said, wait a minute. You know, we just spent an hour talking about how we were running the company as a business that was going to generate value without the need for the gold price to go up. We are more than a leverage play. We've got growing high-quality cash flow. We've got declining capital spending. And that means we're going to generate increasing cash flow and cash flow per share even at a flat gold price. And he smiled at me and said, you know, you're right. I've never thought about a gold company as a real business. And maybe it's time that I start looking at you guys in that way. And so I just want to leave you with that because it's certainly a baby step. It's one investor. But I think it's absolutely a positive step forward. And as I've said throughout the discussion here, I look forward to much more improved performance from our sector going forward. Thank you very much.
All right. Now, Chuck's kindly agreed to answer some questions, so we've got two roving mics in the room, Simon Jemison over here and Gavin Collery over there. If you could please, when you ask a question, stand up, state your name and your affiliation, and keep the questions fairly short, please. We want a question, not a statement. Thanks very much. Simon.
Thanks, Chuck. Warren Edney, I just wondered whether I thought your anecdote about the investor was fantastic, but if you're predicting that gold production will decline next year, do you think many boards around the world will be willing to try and improve their margins and potentially cut back production when they feel that the gold production globally is decreasing, rather than what we're seeing in Australia at the moment, where all the majors are trying to produce as much iron ore as they can to try and get the costs down?
That's a great question and very topical with what's going on in the iron ore business. I just don't see that corollary in our business, where we don't have these large deposits available where we can invest tremendous amounts of capital and drive those costs down. And as a practical matter, because of the way the businesses have been run over the last 10 years, those pools of capital don't exist. The equity markets aren't jumping up and down to give us more capital to invest, and the balance sheets of most of the companies are stressed. So, but your point is an important one, is that this is a hard thing to do, to sit in your boardroom and say, okay, next year we're going to produce, and I'm saying this theoretically, I'm not giving guidance for next year, we're going to produce less gold next year than we said we would a year ago, but it's going to be better production, and our costs are going to be lower, and our cash flow is going to be up, and this is actually a better way to run our business. It's hard to get your head around, because you just intuitively think that more ounces must be better. Top line growth must be something that we should all strive for. And what I've tried to show here, and what I think we're getting in our business, is that you can't just focus on the ounces. You've got to focus on the margins and the actual cash flow and earnings per share. So I hope that in boardrooms around the world they're getting that, and we'll see. Yes.
Thank you very much, Chuck, for your presentation. My name's Sarah Boko. I'm from the Coalition for Eco-Efficient Comminution, and your company is one of our generous supporters, and I thank you for that. I'd like you to just comment on how Goldcorp is addressing the complexity of ore grade, and how you, as a company, are dealing with this increasing complexity of trying to choose the right processing strategies.
Sorry, I couldn't quite hear the complexity of
the ore grade deposits.
Okay.
They're becoming increasingly complex, and therefore the decision making is increasingly complex. And I'm wondering how Goldcorp is staying ahead of the curve on that.
Yeah, well, that's a great question, and that goes to these simple examples that we put up in the kind of discussions that we're having with our mine managers, because really it's the same question as to what the boards are dealing with at a company-wide level. The mine managers have to understand that you've got a $1,200 gold price and a mine plan that produces a particular margin and cash flow at that gold price, and then they see a stringer in the wall that they know they can produce at $1,100, and they think, wow, I'm still making $100 an ounce. What they don't realize is they're compressing margins, and by going after that, they either have to increase throughput or defer the production of higher grade material, which hurts us as well. So I would say it's an education process. It's trying to change everybody at the face, their views towards maximizing cash flow versus maximizing ounces, and so it requires good technical work, so you understand what the ore grades are in front of you and what your margins are as you produce them. Thank you. Yes.
Chuck, Michael Beer. I'd like to just ask you a little bit more about gold price. No one really knows where it's heading. A former head of the Fed in the USA once said that gold is our enemy. I guess he was probably therefore also saying the US dollar is our friend. There's suggestion, we've got two markets for gold. One is the physical and one is the paper. And it's suggested that the investment bankers in New York, particularly the ones who drive the paper market. And I guess the other suggestion you've talked about is China and its growing strength, etc. Would you like to just comment on whether gold is likely to go up as perhaps China strengthens versus the United States economically?
Well, there's so many big macro trends, and certainly I didn't talk about all of them, but one of them, of course, is the desire, I would say desire rather than need, the desire for diversification away from the US dollar as the reserve currency of choice internationally. And that's going to take a long, long time. But clearly, one of the things I didn't show here, but I think you could see it on one slide, is that central bank demand has been very, very steady for the last several years. And often when I talk about gold price, somebody will raise their hand and say, well, wait a minute, so much of the gold ever produced is still above ground. That supply could come flooding in at any time. Well, that supply, most of it, is held in central banks. And I turn the question back and I say, what economically, what is going on in the world that tells you that central banks around the world would prefer to own US dollars, or to say it another way, would prefer to own more US dollars? I mean, I personally believe that given the spending and fiscal policies and monetary policies of the US over the last, since the GFC arose in 2007, 2008, will at some point come back to require inflation in order to take into account all that additional supply in the system. But yeah, there's so many different things you can look at. As I said earlier, I think the US dollar right now is certainly an issue, but as we go forward, I don't think that you're going to see the US dollar remain as the only safe haven in the world. Yes?
Fred Grimwade from Director of Troy Resources. My question's related to the supply side, and I note your comments about peak production. I think I'd certainly agree with that. We've seen the demise of South Africa as a powerhouse from gold production point of view. China now the largest producer in the world. There's ongoing issues in Africa. South America has some real political challenges. I just wonder, as you look at the world and put the risk factors together with the grade factors, which do you think will be the countries that will emerge over time as the future major producers of gold, accepting the fact that there'll probably be a total reduction of production going forward?
Yeah, it's a good question. I mean, we are focused in the Americas, as you know, and we're certainly bullish on the prospects for continued growth in Canada, in Mexico. I think there's still opportunity in the U.S., but that's one of those places that really contributes to that 20-year time frame to build a new mine. The U.S. is great once you get a mine built, but it's hellish trying to get to that point. I think the changes that we've seen just recently in South America, you may have seen yesterday that we had a negative decision in the Chilean Supreme Court on our El Morro project, and I don't think that this means that Chile is all of a sudden a bad place to build a new mine, but they have to work through some of their new legislative changes where they adopted ILO 169 and the concept of free, prior, and informed consent as the law of the land without really understanding what that meant. And now the Supreme Court is telling them what it meant. They'll work through that, and Chile will remain a strong country. I think Peru politically will turn the corner and remain a strong country. In my view, Argentina will get there, and we've just invested in Argentina. We've now got 2 mines there, and you know, it's a challenging place, but once they get through their current economic situation with the devaluation of the peso that has just happened in January and needs to happen again, I think Argentina, you know, from a metallogenic standpoint, has tremendous opportunity, and if the government can keep things headed in the right direction, it's going to be very positive. I'm not as familiar with other parts of the world, although I always say that we look at assets all over the world. We just haven't found one compelling enough to take us out of our comfort zone in the Americas just yet. But I'm sure there's other places that you're going to see, you know, improved and additional mining that will help to offset what we've seen in South Africa and other places. done?
For just a moment, sir. I think we've exhausted the questions, and as I invite Tim Longes from Swan Global to come up to the stage, I just want to pay a very small tribute to Lorraine Meldrum from Swan, who has tirelessly chased Chuck Janez for about the last 5 or 6 years to get him here to speak, and she's finally been successful. So well done, Lorraine. Thanks for your efforts. Tim Longes from Swan.
As the most enigmatic of commodities, gold has continued to fascinate man over thousands of years and continues to this day. Its extraordinary properties, its seductive ornamental allure, its preeminent tradable measure of wealth continue to attract miners both big and small. We have therefore been privileged to have Chuck Jeans talk to us today. His role as CEO of one of the largest gold miners in the world puts him in a unique position of authority to talk on both gold and gold mining. And we are delighted that he has made the time to share those views with us today. Would you please join me in giving Chuck a typical MMC thank you.
Thanks, Tim, and thanks, everybody. Just a few final notices before we finish up. On the table, you'll notice a couple of flyers. One deals with the LME Down Under dinner, which is coming up again, given that Melbourne Cup is just around the corner. The 27th LME Down Under dinner will be on Wednesday, the 5th of November. Bookings are open online, and there are flyers on your table for the address for that, but I'm sure if you just Google it up, you'll find it. The guest speaker is going to be Nev Power, the CEO of Fortescue Metals. Interesting night, I would think, for Nev, given the world's traders will be there. So his view on iron ore will be very keenly sought. Christine Coonan's on table 15 over here, and she can give you more information on that. Also on the table is a flyer in relation to women in resources. They've got a number of events coming up shortly. I think the first one's next Thursday. Professional development seminar. They've got a couple of networking events coming up in the first week of November. So head over to the Gecko table number 13, I think, for a bit more information, or take the flyer with you. Now, if we can impose upon Chuck to draw the winner of our Sovereign Hill Prize, that will be good. The prize is a family pass, of course, to Sovereign Hill. It's a truly amazing development up there, and Jeremy's here to tell you more about it if you would like. He's over here. It includes a ticket to the village and also to the show at night. And the lucky winner is Jeffrey Luckens. Is Jeff in the room? Up the back. Well done, Jeff. Come up and see Gavin, and he'll give you that prize. Thanks again to Jeremy and Sovereign Hill for that. Our next lunch event, the last for the year, will be here again on Tuesday, December 2. This year we're sticking with the gold theme right through to the end of Christmas. If the gold price keeps going up, the market cap of our next speaker will get back to $1 billion. We hope just in time for the speech. $1 billion is our minimum threshold for market cap, and we've generally managed to stick to that. Bill Beeman is the speaker. He's the CEO of Northern Star Resources, which is Australia's fastest growing gold mine, the Shades of Normandy, with this company, and I think it'll be a very interesting talk to hear about how he's put this organisation together. The next Cutting Edge series for our small and mid-cap companies will be held in this building downstairs at 5:30 on Tuesday, November 18. We've got three really good small companies with lots of potential: Western Areas, Emerson Resources and Minotaur Exploration. If we don't have your details and you're not receiving our emails inviting you to these events, leave a business card with the ladies at the front. For media, the press conference with Chuck will be held over here in the Condell room straight after I get off the stage, which is right now. Members and guests, thanks very much for coming. In the meantime, till we see you next, travel safely. Thanks.